Welcome to Breaking News to Trading Moves. Today we're looking at the market activity around NVIDIA, and trying to trace where the capital is actually flowing through the tech infrastructure stack. We want to identify who's benefiting and also which areas might be feeling some pressure because of this investment focus. And that focus, it seems really driven by this one big number. NVIDIA is, well, potentially heading towards a $5 trillion market cap. That valuation alone tells you something.
It certainly does. It signals where the market conviction is right now. But you need to look at why. What deals, what commitments are behind that number? What's really notable here is the visibility NVIDIA has given the market. They're talking about visibility into roughly $500 billion in AI chip bookings.
$500 billion.
$500 billion. When you hear numbers like that, for anticipated demand, it's clear this isn't just a quarterly thing. It's a multi-year build-out.
Okay, $500 billion is.
Yeah.
A massive figure. How much of that is really new spending, though, like from enterprises, governments, or is some of it maybe just orders getting pulled forward?
That's a fair question.
Is the valuation banking heavily on big government contracts, like those 7 AI supercomputers they're building for the U.S. Department of Energy?
It's definitely a mix. But look, the bulk of the spending we're tracking seems genuinely new. It's dedicated to building core AI capabilities, not just replacing old servers. Take the Solstice project they mentioned.
Right.
That's being built with Oracle. It includes 100,000 Blackwell GPUs, just that one project. It shows that big players, governments, enterprises, they're past the experimental phase. They want guaranteed large-scale clusters now.
Wow, 100,000 GPUs for one system. That completely changes the scale, doesn't it?
It really does.
So if Solstice shows the demand scale, let's map the investment underneath it. It sounds like the immediate money is going into the foundations. Data center compute, fast networking, and crucially, the space and power needed.
Exactly. That's the
Driven by the hyperscalers and the whole AI supply chain.
Yes, precisely. The spending isn't spread evenly across IT. It's highly focused on building the actual physical machinery for training these large models and getting them running quickly.
Okay, let's start with the winners then, the direct beneficiaries, what we're calling the AI growth engine. Category 1 has to be AI compute and accelerators, right?
Naturally.
The observation is the demand surge is really focused on training and inference.
And that focus dictates the hardware needed. You see, enterprises and governments aren't just buying standard servers. They're prioritizing these GPU-heavy clusters. They need that massive parallel processing for training.
So they're fast-tracking orders for the best accelerators they can get.
That's right, which means, obviously, NVIDIA is central here.
Yeah.
We're also seeing AMD benefit quite a bit.
Right, competition and supply diversification.
Exactly. The market needs options. So both NVIDIA and AMD are really positioned to capture the spending.
Okay, so beyond the chips themselves, Category 2, AI networking and optical interconnect. You mentioned 100,000 GPUs. They all need to talk to each other.
Super fast. You just can't build these massive clusters without the infrastructure to connect them properly. It demands ultra-low latency switching and a rapid shift to 400G, even 800G optical links. That's essential to scale the training efficiently. Moving from copper to optical fiber. It's a huge change, performance-wise and cost-wise.
But wait a minute, doesn't NVIDIA use its own networking, like InfiniBand, inside its clusters?
Yeah.
Why are third-party networking companies seeing so much investment flow then?
That's a good point. The flow for companies like ANET, Arista Networks, and AVGO, Broadcom, it comes from a couple of places. One is scaling the big external cloud networks that connect all these GPU pods together. The other is, well, all the other networking needed for AI deployments in large companies that might not use InfiniBand everywhere. They provide the specialized switches, the vital optical components, basically the connective tissue for this whole AI ecosystem. So ANET and AVGO are definitely capturing revenue here.
Makes sense. Which brings us to Category 3, data center landlords and capacity providers. You need somewhere to physically put all this powerful connected gear.
And finding that space is getting tricky. The sheer scale of this AI build is boosting leasing and expansion for data center campuses, especially in the US.
But it's not just about floor space, is it?
No, not at all. The why is more complex. These AI clusters need incredible power density, way more than traditional setups, and cooling. So it's actually leading to scarcity. Scarcity of space, yes, but more critically, scarcity of power, available megawatts, and specialized cooling. It's becoming an industrial scale utility challenge.
So who's in the best spot to profit from that scarcity?
It's the established players, the landlords with the existing sites, and crucially, the existing power agreements with utilities. We see this flow helping EQIX, that's Equinix, and DLR, Digital Realty. They own the real estate, they have the power infrastructure, and they know how to deploy these power-dense environments quickly. They're really at the forefront of the physical build-out.
Okay, so we've tracked the money into the AI stack. Chips, networking, buildings, NVIDIA, AMD, ANET, AVGO, EQIX, DLR. Now, we have to look at where that money might be coming from, because this level of spending has to be pulling resources from somewhere else in tech, right?
Absolutely. It's basic allocation. This intense focus on AI infra acts like a magnet for capital, pulling investment away from other tech areas. We're seeing clear pressure points emerge.
Let's look at the first area feeling that pressure, CPU-centric legacy compute. The observation seems to be that the spending share is just moving decisively toward accelerators.
It is, and that's proving difficult for some of the traditional server players. AI workloads are fundamentally shifting spending away from general-purpose servers towards these GPU-accelerated systems. It puts direct pressure on the traditional CPU business, both the mix of chips sold and the total number of units. It looks less like a temporary blip and more like a reevaluation of the CPU's role in the modern data center.
So is this just investors chasing growth temporarily, or does the market see this as a longer-term change in a data center architecture, reducing the need for traditional CPUs?
The sign suggests the market believes it's a longer-term trend. You see companies like INTC, Intel, and also IBM struggling a bit against this narrative that the general-purpose server is becoming less central, at least for the highest growth parts of IT spending.
Okay, second category facing pressure, power-intensive crypto miners. Here, it sounds like direct competition for resources is the issue, especially power.
Exactly. It boils down to infrastructure capacity, physics, almost. AI data centers and crypto mining operations are often competing for the very same megawatts of electricity. And because AI data centers often represent, large long-term corporate or government investments, prioritizing speed and availability, utilities and grid operators seem to be increasingly prioritizing them for new capacity.
So what does that mean for the miners? Companies like MRA, Marathon Digital, and Riot Platforms.
Well, the direct consequence is twofold. One, it can drive up their operating costs if power becomes more expensive or harder to secure. Two, and perhaps more importantly, it can literally cap their ability to grow. We're hearing about utilities pushing back on or even rejecting capacity requests from miners to reserve that grid access for upcoming AI projects. It creates a real squeeze.
A power bottleneck.
Okay.
I know. And the final category feeling the pressure. PC and office hardware. Things with limited direct AI connection.
Yeah, this one's more about investor focus, really. The observation is just that investment capital is concentrating on the AI growth story. Investors are being rational, you could say. They're allocating funds away from what they see as slower growth legacy hardware areas, think traditional PCs, printers, that sort of thing. They're moving that money towards companies with clear direct revenue tied to this AI infrastructure boom. If your business depends heavily on, say, desktop refresh cycles or office printing, you're seen as further away from the main action right now.
The market's rewarding proximity to the AI engine. So that puts pressure on names like HPQ, HP Inc., and XRX, Xerox, as funds rotate towards the infrastructure players we talked about earlier.
Precisely.
Okay, so just to recap the flow here. The current environment seems defined by this intense concentration of capital into AI infrastructure. We track that flow starting with the chips NVIDIA, AMD, moving through the critical networking layer, ANET, AVGO, and landing in the physical data centers, EQIX, DLR. But this growth comes at a cost elsewhere, putting pressure on legacy compute like INTC and IBM, resource competitors like crypto miners, MRA and RIOT, and hardware further removed like HPQ and XRX.
That maps the current priorities pretty clearly. Now, here's maybe something for you to think about going forward. Consider that Solstice project again. 100,000 Blackwell GPUs, just for that one U.S. government system. Given that kind of massive scale, what are the next bottlenecks? We've talked about chips and power, obviously, but what else has to be solved to actually build and operate these things successfully? Maybe specialized cooling technologies? What about memory bandwidth inside the cluster? High-speed storage? Or even the fragility of the supply chain for things like advanced chip packaging? Those could be the next hurdles.
That's definitely something to keep an eye on as this build-out continues. And remember, this discussion is not financial advice or a recommendation to buy or sell any asset. This perspective is purely based on the opinion of the author of the material reviewed.